in just a matter of 2 weeks, the overnight lending rate's been raised to 8% and then dropped to 6.25%. What is the CBK playing at?
No, I think CBK was trying something to try to discourage banks from borrowing from the CBK window by trying to increase it to 8%. But actually, what has happened in the last 2 weeks, the borrowing per day has gone up from just about 12 billion to 22 billion as of yesterday. So I think they've realized that particular strategy didn't work. So now they're trying to change the strategy by trying to say, look, you can't borrow more than the CRR 4.5% in a whole 5 days, a whole week. Which you think, again, is going to create another problem than solving the first problem.
I mean, some are saying, you know, what they've sensed is that there's a bit of a liquidity squeeze and that people are relying very much on the overnight market for their foreign currency transactions. What problems do all of these changing of rates create for the money markets?
First of all, we need to understand something. The central bank has been on a tightening mode, and I think for the last 2 months, for example, they have been doing the same thing, trying to get all the cash out of the system. They have done some repos here and there. They have gone to the market to buy dollars and therefore taken away the shillings. And I think the whole strategy of tightening is to reduce the amount of liquidity in the system. And I think on that particular note, they have succeeded. So I think they should clap themselves because they have succeeded in that. But the thing is that the result of that is less liquidity in the system, and therefore people are forced to probably rely on the CBK window. And you've seen the volumes on the overnight between banks come down from about 28 billion to just about 13 billion as of Monday. But on the other side, the CBK window has gone up. So I think, first of all, they've succeeded in trying to tighten the system. So it's true, there's a bit of liquidity squeeze. But I think it's not to the extent that they have to do what they did today by trying to even limit it further.
All right, now what options are available to investors in the midst of this liquidity squeeze? Some are saying that it's time for people to liquidate their positions in terms of investing in treasury bills and try to cash in.
Okay, that's one of the options someone has. But you see, we have a vibrant secondary market, so which means for the positions which people are not marking to losses, then they can be able to do that. But I'm seeing CBK has another week, because you're expecting the MPC meeting next week to give us a bit of some guidance on the way forward. But even before that one comes, I think what's most likely to happen is most banks are going to be looking probably to liquidate those positions which they are not so much making losses, like for example, the short term, the treasury bills, and probably the bonds that have been holding the trading books that are not more than three years. That's one. Secondly, is going to be continually going to the window, probably trying to borrow from there. But thirdly, there's also an opportunity they can do HRTs, horizontal repos, probably within the banks themselves, for a period maybe of a week, 2 weeks, maybe 21 days. They can do that. And then lastly, if all these things don't work, then obviously they'll have no option than to probably go back to central bank and maybe sell their dollar position they've been holding, expecting the prices to go beyond 91 so that they can sell.
I mean, Fred, you mentioned that there's an MPC meeting to take place next week, and some would wonder whether the CBK was acting too quickly ahead of this MPC. There's a lot of pressure for them to increase interest rates further than what we've seen, and one would say that it's natural to assume that interest rates will change again within a week from now. So what sort of rates are we going to be seeing going forward?
Actually, that's the question everyone is asking. I mean, our expectation, if this decision came through the MPC, would have said it's a long-term strategy for the central bank going forward. But it has come from a departmental meeting in central bank. So what we think is it's a very temporary thing, and there's no doubt that even when the MPC comes, it can't change all these things together. But I think more importantly to note here is, as they're trying to do these decisions, one thing that is going to affect the market negatively is the limit that you cannot borrow from central bank to own lend to your clients or to the other banks, one. Secondly, on the limit also of the CRR for a whole 1 week. I think those are very drastic measures, and those measures should not have been taken because we are likely to see another, a resultant effect, which is going to be this squeeze forcing banks now to probably not only increasing the lending rates or the base lending rate that they've been doing in the last maybe 2 weeks or so, but also we are going to see other point coming through, probably even reducing the amount of lending they've been doing to the productive sector, so that they can be able to remain with a bit of liquidity to be able to do their usual daily obligations.
What does all of this mean for the shilling, Fred? Because effectively the CBR and the overnight rate are now at par. At 6.25%, it's the same rate. And today we saw the shilling trading over 90 shillings to the dollar, whereas last week we'd seen it moving beyond, below that 89 shilling level. So we are seeing the shilling feeling some pressure.
Now we are seeing the shilling feeling some pressure, but I think going forward, one of the reasons why we are doing this also on central bank point is also to be able to squeeze the banks, that for the ones who have huge positions on the dollar, for example, the foreign currency, they can be able to liquidate so that they can have the shillings. So chances are, I think with all the balance probabilities, then you are likely to see the shilling probably isn't coming back to just slightly below the 90 as more banks trying to sell to get more shillings. But I think there's something that we are likely to see. And this has to do with how the central bank behaves next week, depending if they're going to touch on the CBR, if they're going to touch on this CRR thing. Because I think with all these things, they should be able to aim to be able to stabilize the forex, for example, as well as to be able to make sure the market is not much more liquid than expected, so that inflation doesn't go up.
And finally, Fred, what does all of this mean for government borrowing in general? I know that banks borrowing from the CBK is a very different borrowing mechanism in general. But for investor confidence, those looking at the indebtedness of the government, liquidity within the system, dynamism of the currency, this can't bode well. We've already heard of an infrastructure bond valued at 36 billion shillings targeting the diaspora. For those international investors who are reticent, are these good signals?
No, these are bad signals. In fact, forget about the international investors. For the local investors, what it means, first of all, more tightening, and therefore we're expecting going forward less bids and less quantities chasing those treasury bills and treasury bonds. And I think it's going to be very critical to see what happens next week, because on Tuesday, we are closing the 2-year reopening and the 2-10-10 reopening, and you're looking to raise about 13 billion. My gut feeling is you are going to get less participation from the banks, and the few guys who are going to participate, those rates are going to be much more higher. So for the government borrowing program, they should be prepared, first of all, to borrow at a higher rate. And therefore, it means even for the infrastructure bond that is being planned for the diaspora, we are going to see a bit of a squeeze on interest rates and them going up. And therefore, meaning either we don't get full subscription, or if we get full subscription, it's going to be at a higher rates. And I think on the general bonds trading, then therefore it means we are going to see less turnover in the stock exchange, as more people have the pressure to sell, probably to try to raise liquidity. But secondly, for the buyers are going to say, look, let me wait for next week, maybe I can get a better rate, and therefore reduce volumes as well.